Good evening, everyone. My name is Kate Allman. Today we're going to be taking a look at some scary patterns on the S&P 500 and the stock market. For the long term, this should be part 3 of this series. So, yeah, obviously nothing that I say in this video should be considered financial advice. Always consult a financial advisor before making important financial decisions, and consider this video purely speculation. Another thing is, thank you, Benjamin Cohen. He's one of the best finance YouTubers on this platform, and I really appreciate his insights. So, getting into the video, we can take a look at oil. Now, oil is surprisingly important in the economy, but there's a pretty big red flag that happened recently. So if we just zoom into oil here, we can see that just a few months ago, I think 2 months ago, oil was sitting at $55 a barrel and is now really close to 100. So essentially what we've seen is, for the last month, oil's been around $100. And this is not a good indicator. This is not a good event for the stock market. And we'll discuss why oil going up is really bad. So I went ahead and asked ChatGPT. I said, give me a list of all the times oil has risen above 30% or more. And it gave me some dates. So if we go to the next slide, we'll take a look at something. But we can see I have the dates right here. And I want to take a look at what happened to stocks after oil rose more than 30%. So if we look at December 1973, sorry, I meant to say this is post World War II, so 1947 and 1948. You can see right after oil started going up, the stock market crashed. Pretty tough. You can also see in 1973, which is right over here, if you look, 1973 right there, we can see stocks crashed afterwards. 1981, which would be over here, the Iran-Iraq war. You can see 1981, stocks are crashing. Early 2000s, right over here. What do we see? The stock market crashing. 2008, oil started going up. What happened? Stock market crashed. Even in 2020 to 2023, with the Russian-Ukrainian war, you can also see the S&P 500 went down during that time. So these are all the times AI told me that oil had gone up more than 30%. And we can see that usually when oil goes up, later down the road, there's a recession. Usually that's the historical pattern. It's possible it doesn't play out, but I'm just saying, looking at this list and going through the pictures, it doesn't paint too good of a picture for stocks, for oil to have gone up so high in such a short amount of time. And I would argue that every single week we remain above $60 to $70 really increases the chance of a recession. And for a lot of people who don't really know, what is the connection between oil and recessions? Essentially, oil makes it more difficult to, basically, most goods and services in the U.S. economy. So, you can think of food. They need to be sent through transportation, right? The transportation costs go up. Therefore, the price of goods and services usually go up to meet with the rise in costs, essentially, to produce and consume goods. Because it costs more money to produce, companies will just raise the price in order to actually make a profit, right? Because the amount of money these companies are making would go down because the cost of manufacturing has just gone up because of oil has just increased, particularly the cost of transportation. So that's one thing. And that's really the main reason why. But if you think about it too, the average American, they drive to work every single day. If they're having their money eaten at the gas pump, on top of, paying more for goods and services, it's going to really destroy their savings, their economic situation. So for that reason, oil going up is pretty important. It has usually led, well, it's been a contributing factor to a lot of these declines in the stock markets that you can see that I've shown here. And now usually oil going up doesn't immediately crash to the stock market, but later down the road it causes issues. And so that was kind of one pretty scary chart I wanted to show off, and that's why I'm expecting for the long term, for the next 6 months, there's probably likely going to be a recession. And another thing too is we can look at some other recessions. So I want you to keep some of these in mind, okay? So 2020, 2008, early 2000s, 1990, okay? So without looking at this, 2020, 2008, early 2000s, 1990, okay? Stick those numbers in your mind. Because we're going to look at a different chart now, not just oil. But I want to answer the question, can we predict a recession? If you were trying to make a model, how would you do it? Well, I would say one of the best finance YouTubers on YouTube right now is Benjamin Cohen. And he has kind of a formula that he uses that really helps visualize where recessions might occur. And he uses this he uses a formula called the business cycle formula, basically. And for those of you who might be new to investing or aren't familiar, the business cycle describes different phases of the stock market. And so the phases that we'll see are economic hardship or economic collapse, economic excitement, and economic stability. So these are the three phases that the U.S. economy, or just the world economy, kind of enters into these phases, into like a cycle, basically. And we'll go into the equation. So what does this equation look like? The equation looks like the S&P 500 divided by the unemployment rate, and we square the unemployment rate. In my opinion, the unemployment rate is the most important factor to determining a recession. When you start seeing that the unemployment rate really start to spike and go out of control, we're going to be locked into a recession. So that's the most important part, and we really want to highlight where unemployment happens, so we square it, basically. And then we tag on a few other important things. So the Fed funds rate, if you don't know, is interest rates, and CPI is basically inflation, and M2 is the money in circulation. So this might be kind of a little complicated, so let's actually look at it. So right here we have the S&P 500, and ideally we want to create some formula or some indicator which gives us something that looks like this, okay? And we expect that, right here on the tops might be a recession, right? Something easy to understand, like this. I don't know what I just did, but basically that's our goal, okay? So let's try to see if we can get there. So we're gonna take the S&P 500, and let's see what it looks like when we take the unemployment rate. Well, let's just look at the unemployment rate. So this is what the unemployment rate looks like. And you can see that unemployment for the last 4 years has just been trending upwards, which is not a good sign. And one of the issues is that you might look at unemployment going down right here, and you might say, okay, this is a good thing. But one particular issue is that, the U.S. government will come out and say the unemployment rate for this month is, 4.2, let's say. But then they'll actually come back a few months later and be like, we have to make a correction. The unemployment rate was actually higher. So they'll come back and change some of these numbers. So in reality, they could be higher. You just don't know. But this is what unemployment looks like, and you can see that it's been rising for the past 3 months, which is not too great a sign, but it's not spiking super hard, so we might not be in trouble. But like I said, we're trying to create an indicator. So let's see what this starts to look like when we divide the S&P 500 divided by the unemployment rate squared. And we can pretty easily see here, we kind of got something that looks good here. I mean, you can kind of see we got something. And it's not too difficult. If you remember a few moments ago, I asked you to remember where recessions were. But if we look, we can see it looks like we might have seen a pretty good spot for recession there. It looks like it got the early 2000s, where there's an obvious spike, and 2020. So we got basically a basic indicator working, but something I'm kind of noticing is it's kind of going like this, where it seems like the bumps are just gradually getting higher and higher and higher. So what we can do to go from something like this, we want to get this. One way we can do that is by dividing this by the M2, and we'll get something that looks like this. This looks a lot better, in my opinion. I feel like this more resembles kind of what we're trying to go for, at least in my opinion. But a lot of you might not be familiar with the M2, so why does the M2 help give this indicator a more nice look? Well, the M2, if you don't know, is basically all the money that's in circulation. So we can look at this, and basically every single year the U.S. basically prints more money, and as we print more money, the price of everything naturally goes higher. So because this naturally goes up, it kind of pulls up all the other indicators up with it. But that's why if we take our formula, which is the S&P 500, so we'll do SPX, we multiply that. We divide that by the unemployment, and we square it, and then we divide that by M2. This is really getting applied here. So, not really mathematically, but you could kind of see it makes this look more stable. So that was kind of the thought process behind all this. And yeah, we can kind of see that if we start to look at this, we take the U.S. unemployment level, we'll square that, divide it by the M2, and we'll divide that by the S&P 500. To me, you get something that's a little bit more reasonable and easy to work with, at least as an indicator. And you can kind of see just by looking over here, we're pretty high up, which is kind of the second alarming pattern. When you consider oil and this, it does not paint a good picture for the U.S. economy. But then, there's other important factors. So, for example, there's CPI here, U.S. And, this kind of shows us inflation. How goods and services are kind of inflated. So we can do squared. Let me just redo this one. And yeah, we just kind of include it into our calculations. It doesn't change a whole lot, but you can kind of see now it's much more like this once we start to include these different variables. And the last variable we're missing right now is interest rates. But we've got a nicer looking sort of equation and graph to look at that kind of tells us when economic situations are bad. When this goes up, what this is telling us is that unemployment is high, interest rates are high, and inflation is high. All those things are bad for an economy. So when we see this really elevated, it's not good. And we can clearly see, if we look, we're pretty high on this list. And we've even gone a little bit higher recently. So that's essentially the equation, and I've tried to explain it the best I can. And once you do this full equation up here, we get something that looks like this. And this kind of can help us at least see where we might see recessions. And so if we go here, you can see right now we're pretty high up on this, which means we're not in a good situation economically, at least in terms of unemployment, interest rates, and inflation. Now, the main thing that's really hurting us right now is actually interest rates, which I'll discuss in another video in my risk series, what interest rates really mean. But just know that usually when interest rates are high, it prevents people from buying houses, buying cars. It hurts businesses because they're not able to take out loans and then use that money to hire new employees. So not only does it hurt consumers, but it hurts businesses. And because it keeps consumers restricted, where they won't buy houses, won't buy cars, and because it keeps businesses restricted, because they won't borrow money to put into new projects to hire, which they would need to hire more employees, it creates a harsh environment for growth, essentially. And that's kind of the situation we're in today, if you look at this equation. But we can kind of take a look, if you do look at this equation, like I discussed, we can see 2020 recession happened right around there. The 2008 recession happened right around there. And the early 2000s recessions happened right around here. What we can do is we have this indicator. Let's actually just show this with the S&P 500. So we'll overlay the S&P 500, and it's not hard to see that when this starts to go down, the S&P 500 crashed there. When this indicator started going down, we saw it crash over here as well. That one should look pretty obvious, but yeah, we're in pretty heated areas over here, and I would expect us to crash pretty soon, just due to this. And I use some fancy code, to split this business indicator into different groups. So you can see whenever this indicator starts to rise, we see blue. When the indicator is really stable, you'll see green. And when this indicator starts to fall, it's in red. If you were paying attention to the previous slide, every single recession happened in one of these red sections. Every single one of them happened in the red sections. Recessions usually happen, if we look, they usually start to happen when this when our business cycle indicator really starts to take off. What's going on here? So when we really start to see a drastic drop, for example, right here, where we just instantly came down, that's what usually starts the recession. Like for example, over here, we had just a fallout super fast, and this crash in this metric is what led to a recession happening. You can see it over here too, where there's just a very fast crash. And that's usually when the recession happens, when you see this indicator start to free fall. And that's why we haven't seen a recession yet, because these variables haven't just crashed down. So we're waiting for a sudden drop to really kick us into a recession and for us to start all over again. The interesting thing is actually, if you look at these different sections, so when the business cycle is suddenly rising versus when it's falling and crashing versus when it's just very stable, some assets perform different and behave. Some assets perform differently and behave differently. For example, when we see these blue areas, where we see a sudden rise in inflation, unemployment, high interest rates, usually it's U.S. defense stocks, tech stocks, and the S&P 500 that does the best in these blue areas. But in these red areas, it's gold, bonds, and metals. And if you don't know, those are the absolute safest. So I should say I had a bunch of stocks that I had did analysis on, and I compared these stocks and how they performed in these different sections. And the safest stocks that I had in the entire list did the best in the recessions, basically. And you can see the safest ones were gold, bonds, real estate, healthcare, right? These are things that basically everyone needs. They're metals. They're used everywhere. So obviously those are safest and they did the best. But if you look at the riskiest assets did the best in these blue areas. And actually in the green areas, it's the basic stuff that did pretty well. Copper, energy, natural gas. So what I'm trying to say is in these different areas of the business cycle, you should be thinking about where you're allocating differently and then you're investing differently into these different sections. So, a lot of people will tell you to do the best thing to do is to always buy the S&P 500. And, for a beginner who doesn't want to invest a lot of time in the stocks, that might be good advice, right? But just looking at how the economy evolves into these different cycles, how the economy is infected by these different aspects of inflation, monetary policy by the Fed, you can make better decisions and save more of your portfolio by putting yourself in the best position during each of these cycles. And one thing you should know actually is these things take a long time to play out. So if we look, let's look. We had one spike here, one spike there, one spike here, and another spike there. So we have 4 spikes, and this data spans almost 40 years. So you can see, if you look from 2009 to 2015, this metric barely went up. Sometimes the metric can just basically do nothing for long periods of time. And, it's going down all the way through here. From 2019 to, from early 2000, I should say, from early 2000 to basically 2005, we're just going down. And then we're going up for the next 4 years over here. The point I'm trying to make is that usually these trends, these patterns, they play out for multiple years, for a lot of different years. That's kind of this is a long-term outlook essentially. When you're looking at this, you're planning for the long term. You don't want to just change into these different assets every single day looking at this. But what this is communicating to me is safer things tend to be the assets that you want to go into, what are called defensive stocks. But anyways, just looking at the business cycle, this usually plays out into a recession. And then we looked at oil, which usually plays out into a recession. And kind of the third pattern we're going to look at is the S&P 500, and we'll look at the M2. So if you remember what I was saying, is the M2 is basically all the money that's circulating in the economy. And you can see just over time, we print more and more money. And now, one thing that's kind of important to look at that might not be obvious, but it looks like I'm not good at using this software yet. But let's see. Oh my gosh. It looks like most of the inflation happened right around here. But if we were to take the S&P 500 and divide it by the M2, oh no. We get a chart that looks like this. Oh my gosh, I have drawings. I need to do a better job recording. Okay, so we have a pattern that plays out like this. And we can see over here too, we had a lot of money in circulation in the US economy. But I want you to kind of look and see if you notice any similarities. I'll give you a few minutes. And the thing we're going to look at, I think it's this. Let me quickly check. What we're going to do is come over here and we're going to see how this played out. Oh my gosh, I don't know how this thing works. Bruh. Oh, I clicked on it. I didn't even click on it. Oh my gosh. Okay. Let's take a bar pattern. So let's look at what happened over here. We'll leave it right there. We'll duplicate this. And if we look, I mean, I can't be the only one who sees it, right? These two patterns are playing out almost exactly the same. We saw a crash here. We saw a crash here. And we saw a crash here. And if we move this up, so let's take the pattern and move it down, you can see that if we line this up, it matches pretty good, right? I think it matches pretty good. And it's shown us a lot where it showed us a lot of how the stock market was behaving and where crashes happen. And if we look over here, you remember this was also a recession. And this is a pretty terrifying pattern to be looking at, because if we end up just for this entire year just going, you know, imagine this is the S&P 500. If we just end up just doing this and falling into this pattern, I mean, what are the odds that we just play out another drop like we just did over here? It's pretty crazy how similar these two are. I mean, even look, if you look even over here, there's a crash. It's got it here, predicted there, predicted it there, predicted it there. And even you can see it was going up over here. Just how we went up. So, yeah, it's not a good pattern to see being playing out. And I really hope we don't follow through on this. And it's hard not to like look at and be a little bit worried. So yeah, those are basically most of the patterns that I wanted to discuss today. And it's kind of my perspective that people should be a little bit more cautious when investing, especially in these times. We looked at, you know, oil usually leads to recessions, you know, once it spikes 30%. We just looked at the business cycle, this formula, and usually when it starts coming down, we've hit a recession. And the last thing too is when we look at the M2, which is all the money in circulation, which usually goes up because of inflation, we can see that really emulates a lot of behavior that we were seeing in the 1980 recession. Oh, sorry, early 2000 recession. We're seeing this exact same thing almost play out here. Yeah, it's kind of scary stuff. But I won't be too worried, and I would not sell all your stocks right now. You know, there are ways to make money during these times. So for example, I don't want to spend too much time, but there are some defensive stocks I wanted to discuss. This video is going a little bit longer, but if we look at like XLE, I mean, if we go back to other recessions, for example, in 2008, you can see this blue stock is XLE. It was going up for several months, even though the S&P 500 was deteriorating. If we go here, we can see the S&P 500 was going down, while XLE was actually going up during that same time. We can also see over here that basically the S&P 500 was deteriorating over here, was going down. XLE was actually kind of going up right around here. You know, the S&P 500 was already down like what, like 20%? XLE was still hit an all-time high and then started to deteriorate later throughout the year. If we go through, I mean, even over here, look, the entire time the stock market was going down here, XLE was actually climbing the entire time. So there are certain defensive assets that you can actually invest into, and they'll usually stay up even if the market starts to deteriorate. Now, obviously, if you look over here, you know, XLE and the S&P 500, we can clearly see right here, I mean, they both started going down eventually. They both tumbled down together. But the thing is as the stock market was deteriorating, you still were able to make money for a few months in XLE. And as you saw the S&P 500 deteriorate, you know, you would be able to stay out of the market unfazed and just wait a little bit while and just buy back in later, right? When all the issues have been resolved in the economy. As particularly, you know for a fact this has been resolved. I have the business cycle on my website, so we can take a look at this over here. But you know for a fact it's been resolved once we kind of went into these lower zones, that we were now in a more economically stable environment. Yeah, so anyways, there's a few defensive stocks I'll talk about in a later video. And I'm not trying to panic anyone with, you know, the analysis that I did in the video. I'm not trying to panic people, but I just want people to have a cautious stance when investing, especially during these what seems to be like pretty uncertain times. So that's all I had to discuss today. Thank you so much for watching, and I hope you have a good rest of your evening. Thanks so much.